So let's start another important topic for the net present value calculation, and that is the impact of taxation on investment appraisal or NPV calculation. So the basic concept, let us read from here. So the basic concept is that taxable profit of business is taxed at the corporation rate each year. So a taxable profit figure, which comes as revenue minus allowed expenses of business, is taxed at the corporation tax each year. So let's assume that the corporation tax rate is 20%. Let's assume this. And our revenue that the business has earned is $150 and the allowed expenses. Now, what are the allowed expenses? These are different from your accounting expenses. These are the expenses that are allowed by the taxation authority to be deducted from revenue. So minus allowed expenses, let us assume that the allowed expenses amount to $50. So we deduct the $50 and then we come to the figure known as taxable profit. So these are the profit. This is the profit figure that would be taxed at the corporation tax rate of 20%. So the taxable profit figure is $100 in this example, and then now let's calculate the corporation tax that we will need to pay here would be equal to $100 multiplied by 20%. So the corporation tax we need to pay of $20. Now, is it in our favor to increase the revenue? If the revenue is increased and allowed expenses are not increased, then obviously corporation tax would increase. So let's say our revenue has gone up to $200, corporation tax has increased now because of course taxable profit have increased. Now, if allowed expenses are going to increase, let's say they go to $100 from 50 to $100, then the corporation tax has reduced. So of course, increasing the allowed expenses, if we are granted another expense as an allowed expense by the taxation authority, then obviously that is going to reduce our corporation tax, and so will be in our favor. So the businesses, the government, the taxation authority, what does it do? It does one thing. The government facilitates the new investments in new projects. The governments are the taxation authority. They facilitate investment in new projects. Why? Because of course, if the businesses are investing in new projects, it is going to be better for the economy. So that is why they facilitate investments in new projects. So whenever the business is investing in a new project, the taxation authority says that if you are going to invest in this project, then I am going to allow you and other expense to be deducted from revenue, which will of course reduce the taxable profit and hence result in reduced corporation tax. So what is that allowed expense that the the taxation authority is now granting us to be treated as an allowed expense? That expense is known as TAD. So now let me write it here. So there is another expense that the government will allow me to deduct it from my revenue figure, and that is known as another uh, allowed expense. Let me just write it here, AE allowed as allowed expense, and that allowed expense name is TAD, TAD, TAD. So the government has allowed me to deduct another expense named as TAD if I accept the project. So I should write this here also, if accept the project. If I accept the project, if the business accept the project, if the business invest in the project, then the taxation authority has allowed the business to deduct another expense that is known as TAD. And let's assume the TAD expense is minus 50. So now the taxable profit figure would decrease to $50, and the corporation tax that the business now needs to pay would be equal to $50 multiplied by corporation tax rate, which is 20%. So how much tax is reduced? If I do not accept the project, then my corporation tax will be 20, and if I accept the project, if the business accept the project, the corporation tax would be reduced to $10. So what is the tax savings? Tax savings is equal to 20 minus 10. So uh, when we studied the relevant cash flows topic, the previous topic, we talked about that the incremental flows are relevant. Incremental flows are relevant. These are the additional cash inflows or outflows that occur as a result of accepting the project. Then we looked into the opportunity cost concept. What was the opportunity cost concept? These are the lost cash inflow. These are shown as a negative figure, because of course these are the opportunity cost, because these are the cash inflows that are now lost as a result of accepting the project. So these will be shown as a negative figure. Similarly, the cost saved, these will be shown as a positive figure. So what type of cash relevant cash flow is this tax saving? This is obviously a type of cost saved, because if we didn't accept the project, if we reject the project, our corporation tax would be $20, and if we accept the project, our corporation tax would be reduced to $10. So how much tax have we saved? We have saved $10 of our tax, right? So this is the saved cash outflow. So this will be shown as a positive figure in our NPV calculation. So this is just the basic concept of how the corporation tax works. So in the next video, I'll be showing you the detailed calculation for these figures, and will tell you what is meant by this TAD figure, TAD. So we will meet in the next video. Bye.